What's going on, guys? Welcome back to the channel. If this is your first time at our channel, welcome to the channel. My name is Travis Sickle. So in this video, I want to go through some retirement numbers, savings numbers, and trends that is a report from Fidelity. So really it's looking at how you stack up against everybody else. Now, as we go through this report, which I just got, I haven't gone through the complete report, so we're going to go through it together. Basically, for my first time, your first time, we're going to go through these numbers. Now, the numbers don't lie, but what you can draw those conclusions from those numbers might be a little skewed. So just keep that in the back of your mind as you're looking at some of these numbers, and I'll do my best to kind of point those things out as we go through it. So I'm just literally just going to pull up this PDF on the screen and we're going to go through it together so you can see the trends and how you stack up for your retirement savings, your retirement plan against everybody else, or at least for Fidelity. They're pulling these numbers from the accounts that they manage. So that's how they figure this stuff out. And this report is called Trends and Insights for Those Saving for Retirement Across America. So let's go ahead and I'll pull it up on the screen and we'll go through it together. So building financial futures, here we go. So the positive note here is that in Q2 2021, participants continue to improve their savings rates and balances. Reached a new high. So right there, balances reached a new high. S&P 500 is at all-time highs, and it is also up 18%, or roughly thereabout. I was looking at yesterday, 18% year-to-date with the S&P 500. So we're going to be looking at defined contribution plans and IRAs. A defined contribution plans like your 401k, 403b, anything that you're saving into. Those are defined contribution plans. Where a defined benefit plan, the opposite, would be something like a pension, where it's giving you a set payment in retirement. So those are the differences. And then IRAs you're probably more familiar with, which are basically the same thing as you save into them, and then you have that balance and you can spend what you want in retirement. So the next page, a moment of balance. So here's some more stats. So 2/3 of employees experienced at least one major life event in the last 6 months. Not surprising at all. 42% feel hopeful. That is actually a little bit on the lower side at this point. I think it should have been a little higher than that. 20% feeling very anxious. And then 1 in 4 said they do not plan to resume life as it was pre-pandemic. I'm actually surprised it's that low. I was expecting that to be significantly higher. Even if you're in like the same job, your whole life is so much has changed in the last 12 to 18 months. So it's kind of interesting that is so low. And let me know what you think in the comments down below as well on all these things. 1 in 4. Are you resuming life as it was pre-pandemic, or something in your life changed the way you're looking at it? For your retirement, your personal, if you changed a job, you're thinking about changing a job, so much of that stuff has changed that I'm surprised it's only 1 in 4. So the next page says the impact of major life events. And we will get to the retirement plan numbers. I know they're further down on this report. 28% did some major home improvement. So that's interesting too. And that was actually one of the catalysts for this things like at Home Depot. If you go to Home Depot, wood has like basically doubled. So it's been a while since I've been there, maybe like a couple of weeks. A couple of weeks. But Home Depot, those prices have skyrocketed, and that's why. It's not people had, they were home, they were doing home projects, going to Home Depot, going to Lowe's, doing these things. And also the people moving. You see the housing prices increasing too. And then there's new home builders. People don't want to wait. They want to make those changes. So that's where that's being reflected. So you can see that. 17% experienced a medical crisis in my family. I don't know how that stacks up normally. So 17% might be high. It probably is a little bit higher, but I don't know if that is significantly higher or not. I mean, maybe it's even lower just because people didn't go out and they weren't going to the doctor for a while. 17% cared for an aging parent family member. 14% experienced the loss of a close family member. And I don't know how that stacks up normally. 14% started working from home full time. 14%. That's really low, really. 14% started working from home. I guess the 14% of the people that were working then made the jump to work home. Maybe that's what the number is showing you. 14%. I don't know. Are you one of those people? Let me know in the comments down below. 14%? I would assume that's going to be significantly higher, as a lot of people realize that working in an office environment is not necessarily important. How many call centers have you called into, including, I think, the IRS? If you call the IRS, they're all working. A lot of them are, not all, a lot of them are, I think, are still working from home. So I'm surprised that it's only 14%. And 68% of participants said that they experienced at least one major life event in the last 6 months. Really not surprising again. All these things are life events. So 68%. Next page is intense emotions evened out. So this is comparing 3 different time frames. So we have September of 2020, November of 2020, and then May of 2021. So I looked at this a minute ago. So this page, not surprising again. You see the trend. People were really stressed out in September. Then it spikes in November because we got an election and a pandemic. And then things started to happen. Vaccines started to roll out. Things started to open back up. People started to go back to work. And obviously the election was completed by then. Now May 2021, so it drops. The stress drops. Fast forward to hopeful, and it's basically the opposite trend, where it was high, then drops, and then increases. So it's basically in line, the inverse of stress and hopeful. So kind of interesting. If you want to look for more into that, again, I'll leave the link in the description at the bottom. Savings and investing behaviors stabilized. So in the past 3 months, have you saved more, saved less, or saved the same amount as the previous 3 months? So it looks like we have maybe a couple of different time frames here. So saved more in 2020, 34%. No impact on savings, 40%. And then 27% said that they saved less. I don't really, does that surprise me? Not really. I mean, people make changes all the time. Things change. And that shift going from 2020 to 2021, Q2, quarter 2. So that's Q2 of 2021. So saved more started to, I guess, decrease, but had no impact, just more stagnation, and then saved less. So less people saved less. So that is not surprising. I think that in the beginning of the pandemic, it was, we don't know what's going on. Let's tighten up the money to make sure that we're not spending as much, to, okay, now we're getting all this stimulus, so things are easing. Maybe there's some hope. And then, okay, we can go back to, let's save a little bit more because now we have more money, or we feel a little bit more comfortable. Now, everyone's going to be different. Some people don't feel like that at all. I mean, there might be comments down in this video that says, this is ridiculous, like I can't save, like I can't make ends meet. And there are other people saying, hey, you know what? Life's great. Market's up a lot. Maybe you're working from home and that work-life balance is improved. Maybe you are spending less on gas money. There's a ton of different things. A lot of change. I mean, I think that's the common theme in this. Over the past 3 months, how, if at all, have you changed? How are you investing your retirement savings? So being conservative, no impact, to getting a little bit more aggressive. So again, that's not surprising at all. So in Q4 of 2020, so we're just going into 2020 of Q4 to Q2 of 2021. So more of an anxious moment in the country to a little bit more of an ease. So that less conservative, not fearing the market. And then going to no impact at all. A lot of people said, okay, fine, we're just going to do nothing. And then less people, I guess, got more aggressive. I guess that was surprising. I would have expected more people to get a little bit more aggressive from Q4 to Q2. Because what did you see in the headlines? You see things like GME, AMC, and people taking these crazy risks on these stocks. And some people did well on them. Some people probably didn't. And even with cryptocurrencies. But the thing that you need to be aware of on that stuff, aggressive doesn't necessarily always equate to making more money. If you're taking risks in those types of securities or investments, what you have to realize, and I think about this, like you look at the price of like cryptocurrencies or AMC and GME, those are the ones that are just coming to mind. that you look at where it was like 6 months ago, 8 months ago to where it is today. And then you're thinking, wow, if I had just gotten in, I could have made a bunch of money, and maybe some of you did. But the truth of the matter is most people aren't in at the bottom and then are not selling at the top. It happens all over the board. So an individual trader, an individual position might not have been that great. Even though you see the overall price run up, a lot of people could have gotten in and done a lot of trading, buying and selling, day trading basically with those individual securities. So that's also data that we don't really get that often from individual traders. So you don't see, okay, this stock price ran up. How much money did you actually make? When did you actually get in? And there's instances where you might not have made anything because these things were so volatile. It wasn't starting here and going straight up here. It was up one day, down the next. So that is an emotional roller coaster. So just keep that in the back of your mind when you're thinking about that. Being conservative, being more aggressive. So I don't really think that just being aggressive means you're going to make more money. And also being too conservative, that's a thing. Being too conservative, running to bonds. I mean, that's what a lot of people do. They're like, oh, well, bonds are more secure than equities. I don't agree with that either. And the reason being is because bonds and bond funds are, in my opinion, on different spectrums, on different planets. And they get lumped together when we're looking at diversification. And I think we're going to see more of that in this report. I think. I'm not sure. But you have to think that in the back of your mind because the same thing goes on with bonds. And bond prices right now, I mean, bonds are a risky business because the interest rates are still so low. And that affects all of the rates of all of the different bonds. So I don't know about that. Anyways, so let's go to the next page. Feeling better about life, yet many concerns remain. So let's see. We have the different areas of your life. So we have finances, your health, your work, and your life. So how do you currently feel about yours? Your finances. So your finances actually decreased. Interesting. People are, I guess, less financially secure than they were in November to May. That's surprising. Just because the market's done so well. And I think we're going to see savings rates increase. Your health, the same thing. It's a decrease. How do you currently feel about it? Excellent, very good. So less people feel excellent or very good. And work, 40% people are not happy with work, but yet life, people, that's bizarre. That doesn't make sense. Finances, health, and work didn't meet the grade for excellent and very good, but life's great. That's strange. I don't know. Maybe it's just the way the question was worded to the people taking these surveys. So that's really interesting. And then the political environment. So let's see what this says. How much do you agree that each is causing you stress? So that's not surprising. The political environment dropped is a stressor from September of 2020. I mean, that was, thinking about the election, May 2021. Coronavirus pandemic has dropped. Things have been opening up a lot. And then social justice issues. It is what it is. I'm not going to get into that one. So let's go to the next page. Ready for change. So in the next 6 months, what, if any, changes do you plan to make to your work life? All right, let's see. Look for another job outside of my current company. Seems to be a big trend, but 13%. So that's the survey. And that kind of aligns with what you're seeing in the media. A lot of people are saying, you know what? I don't want to go back to work. I like this work-life balance. I want to work from home. And I want to look for a job that can support that. Other 8%, start a side job, 7%. I love it. Now, I don't know what to compare that to, though. I wish they had a comparison from another time frame on that. Start a side hustle. Anyone out there start a side hustle during the pandemic? Let me know in the comments down below. So, and retire. Let's go back to start a side job. A lot of those things, you're sitting around thinking, like, what else can you do? And you go out and you make a business online. I know that's a lot what I've done. I've done a lot more a lot more videos since the pandemic. The YouTube channel has increased significantly, and we're not feeling that the need to go out into the marketplace the same way that we did. I know that the company has changed tremendously on that, but I feel like it's for the better. So whether or not you consider this a side hustle, I guess it is for the YouTube channel. And then retiring, 5% said forget about it. I'm surprised it's actually that low. A lot of people have said, you know what? If you're just a couple of years out, the pandemic hits. I think in the beginning of the pandemic, it was, oh my goodness, what is going on in the world, our country? But retirement-wise, the market went down so much, and that was a huge stressor for a lot of people. But then it came back. So then it's like, okay, well, can we just retire? I'm surprised it's that low, 5%. I guess, I guess this is a change in your work-life balance, a change that maybe you wouldn't have done previously. So, again, one of these things, the numbers are what they are, but how you interpret them, completely different. 32% want to make at least one change to their work lives. Yeah, that's not surprising. I actually think that's lower. I would have almost thought that was double, that people want to change. Maybe not even work from home, but maybe even just change what they're doing altogether. They realized what they were doing previously wasn't their passion. So they're like, you know what? I've got this time. Let's make a change. So interesting. 3 things for employees to consider at this moment in time: making change to contributions. Number 2, recovering from financial emergency and planning for a future one. Make it an emergency, a cash reserve, right? Take a fresh look at your investments. So let's go ahead and see what these trends are. Define contribution plan trends. So these are the 401k. So auto enrollment, AE. So I did look at this page before, and it is interesting. So the average participation rates in DC plans. So in 2010, it was 66% of people. Fast forward to 2018, 73.5%, more participation. And 2020, 72.9%. It dipped a little bit. Now, again, remember when I was talking about those numbers? Numbers don't lie, but you got to look at them a little closer. I don't know how many people stopped or slowed up their savings who had the ability to continue to do so versus those who might have gotten laid off. So the difference between 73.5 and 72.9, not a whole lot there. So I wonder if that had an impact on that number, rather than saying, okay, these people didn't have the ability to do it. Maybe they just got laid off, or maybe they switched jobs. I mean, there's just so many different factors to kind of think about that, to say, did the pandemic cause people to stop saving? Again, I don't know. Average participation rates, AE plans. I mean, overall, yes, but again, average participation rates, AE plans versus non-AE plans. So auto enrollment. So the auto enrollment from 2010 to 2020. And look at that difference in the auto enrollment plan. So here's what's interesting about that. I think the auto enrollment feature in a plan is a great thing. I think encouraging people, really getting, the earlier that you're saving, the better off you're going to be. It's like ripping off that Band-Aid and just doing it. What people are really great at is adapting to their financial environment, their economic environment, even though you might not feel like it. They do. They're really good at it. So you basically live within, a lot of people live with above their means, but they adapt to it. So that could go both ways. That could be a good thing or a bad thing, that you see a lot of people making a lot of money who still have a lot of debt. And some people who don't make a lot of money have less debt. And you might ask yourself, like, why is that? It's because people are really good at adapting to their environment. And that's not always a good thing. So you could adapt to your environment in a negative way. And in this instance, saying the auto enrollment feature is really good. Well, here's why I say that's a good thing for the greater good of people saving and encouraging that savings rate. But if one employer had this feature of auto enrollment and another employer did not, that would not sway me at all from going to one employer or not, because you're going to save what you're going to save. So if you go to that plan and say, oh, this has an auto enrollment feature, that's not going to benefit you. If you're going to save 3%, well, guess what? That auto enrollment feature, which I'm pretty sure they're at 3%, that's going to kick in anyways. So it's irrelevant to you per se. But again, overall positive thing, auto enrollment. And then the auto enrollment plans from 2010 to 2020, average participation rate for auto enrollment plans is increasing. Again, not surprising, going from 81.8% to 87.2%, that there's more participation. Maybe that's just because people are like, hey, you should save 3%. I think people are getting more educated and aware that they should at least get to the match, and that's usually where it falls. So, and then there's, let's see, going from 2010 to 2020, and that doesn't surprise me either, that there's a little bit of a drop from 2010 to 2020. And that might be due to more plans adopting the auto enrollment feature, especially the larger corporations, which unfortunately, or whatever you want to say, they might have lower paying jobs. So lower income workers. And if the vast majority of lower income workers have the auto enrollment feature, then they're going to be put on the auto enrollment feature. And maybe they'll say, hey, you know what? This seems like a good idea, so I'm going to do it. I'll just leave it as is. So that's a big thing, right? People don't like change, so they just go with whatever is the current situation. So I think that's what is driving those numbers, that the auto enrollment feature, people are aware that there's a match. You get that free money. It's a good thing. You need to prepare for your future. We have less pensions in society. And then going from the non-auto enrollment plans, that has decreased. Mainly because I just think that when people are looking at it, they feel like they have more control and they're not making that push to it. So I think that's why it's decreased from the non-auto enrollment plan. Because as you go from a plan that's not auto enrolled to one that's auto enrolled, again, that's my hypothesis of why that is. So, and then it's also saying participation among millennials has increased by 46% over the last 10 years. In part due to employers adopting auto enrollment. So there you go. I mean, that's a huge driver of that. And really, I didn't even see that bullet before I made that statement. So anyways, contributions hold steady. So average DC plan total savings rates, employee versus plus employer contributions combined has increased. Not surprising, as of Q2, the end in the year noted. So that is probably a driver of the auto enrollment feature that we just talked about. So if that's increasing, of course, people are going to be saving more. And if you're saving more, then the employer is matching those dollars. So there you go. The average DC contribution amount. So this is interesting, right? $7,580 is the average employee. Now, I don't know the range on that. So 6.9% of participants contributed to their 401k plans, decreased their deferrals during Q2 2021, down from 9.8% the year before and 7.5% in Q1. 65% of deferral increases, deferral means contributing into. So deferral increases, contributing more, were due to auto increase programs in Q2 2021. There you go. So those trends, that's what they're finding. $77,580 for the average employee getting the match. Now, why? Why do you think? Why do you think the employer contribution is lower? Why do you think it's only $4,070 where the employee is going above and beyond what the employer's matching for them? Reason being is 50 cents on the dollar. That's my guess. 50 cents on the dollar up to 3%. And that's roughly, we're very close to that amount. So maybe somebody's contributing 4 and they're getting a match for 3 on average. That's probably where it's coming from. So you save 3% and the employee, or you save 6% and the employer is going to give you 50 cents on the dollar up to 6%. So really that's 3%. That's where that math is coming from. Not the employer is just flat out, I mean, from a net dollar amount, they're contributing less, but that's how you incentivize the employee to contribute more, is doing a higher amount, but a lower percentage, which is a good thing because that means you're going to save more. That's a good thing. DC plan, and they're also getting the money in there for you. DC plan balance. So let's see, defined contribution average balance. With the recent market activity, balances have increased by 4.4% from the previous quarter. Wow, that 4.4% from the previous quarter, that doesn't seem good at all. The market's up much more than that. That means people aren't invested correctly. Additional insights: with average balances increasing this quarter, those who have been saving over the long term have saved an average of $511,900. Wow, 15 years. Millennials who have continuously invested in their DC plans for 15 years have an average balance of $278,600 in Q2 2021. That is interesting. I'm gonna have to do some calculator work on that before. Over 15 years in order to get to $278,600. Interesting. DC average balance, that's increased from 2011 to 2021. That has increased. Is that a factor of inflation? We haven't had much inflation. 73,000 to 129,000. I don't think that's totally inflation there. That's more. People are saving more, probably because of that auto enrollment feature that we've just been talking about. Average balance for employees continuously invested in DC plans for 15 years. That's good. $500,000. I think that's roughly, just think of it in terms of like the 4 to 5% rule. So really like 500 grand is going to give you like $25,000 a year. In retirement income in general, depending on how you invest and what you do, but rule of thumb, one of those rules, right? As of Q2 in the year noted. Interesting. That's increased significantly. So many factors in there. I think people are getting more engaged into investing just because of the online trading platforms, whether or not they're, the actual platform is doing a good thing or a bad thing by almost gamifying how investing is done for a lot of new investors, but it is getting them interested. So it has to start somewhere. And if they're doing it there and they're then turning around to the retirement plan, at least the retirement plan is probably limited on the investment choices, so that they're not taking quite as much risk, even if they wanted to. They wouldn't be allowed to or able to inside of some of these retirement plans. So possibly a good thing. Next page, investment diversification improves over time. Now, this improves over time. What does that really mean? Is that a good thing or a bad thing? This is a difficult one for me because I think you can over-diversify, and I think a lot of people lean towards over-diversification. And I know Fidelity is not known specifically for this, but they have a lot of target date funds. So if that's something that they're selling, they're going to be pushing them a lot. And that's not always the best investment option. And it says here, baby boomers are the most likely generation to be too aggressively invested, potentially putting them at risk so close to retirement. What a statement. So what do you do if you're in a retirement plan, you're getting close to retirement? And I think that there's this ideal with diversification that you move from equities to bonds to be more diversified. But I don't know. And I've talked about this before. I've done it on other videos. If you have questions on this, let me know in the comments down below and I'll dive a little bit more into it, I guess, in future videos. But bonds and bond funds do not do the same things. They don't work the same. They act more like an equity. And in bond price, if you buy an individual bond and you hold that bond to maturity, then you're going to get the principal back. So you're reducing basically like market risk. But bond funds don't do that, because inside of the bond funds are always buying and selling. So you're basically getting the effect of the changes in interest rates when that occurs. 69% of millennials are 100% invested in a target date fund. I know that it's the easy button, but the issue with that is sometimes they're a little bit more expensive, but I don't like to dwell on the cost too much, because the pros and the cons of whether or not there's a half a point or a whole percentage of a fee versus somebody going out and investing themselves who really doesn't understand investing, it's worth it to pay the fee. I don't even think that you should bat an eye at the fee in that term, especially if you don't know what you're doing and you're not going to go get financial help to actually build your portfolio. But 69% of millennials are 100% invested in target date funds, due in part to being auto-enrolled in their 401k and default into the option. So the second half of that point is really important. If you looked at that and said 100% are invested in target date funds, therefore should I be? Or 69% or 100% invested, should I be? A lot of people want to go with the herd mentality, just factor. When I say it like that, you're probably like, I don't want to be a sheep, right? You want to do your own plan and build it yourself for your own goals, but not there. That's unfortunate that is the default option, but I don't know. What else can you make as a default option? You don't want to put it just in the S&P 500 for everybody as the default option, because you need a mechanism to make that adjustment depending on somebody who's younger versus older. That's why they're probably just opting to go with a target date fund, because it's already labeled for a certain age group. But again, I would prefer to see people who are going out and taking the time to go out and invest for their particular goals and educate themselves on whether or not they should be in bond funds. And that's really my biggest gripe with the target date funds and this improving of diversification. I don't subscribe to that you can improve diversification over time. There's a better more diversified portfolio is better than another portfolio. I do not believe that. I do believe that there are very diversified portfolios that you should not be invested in. And I believe that there are highly concentrated portfolios or almost investing in just the S&P 500 is better than this stuff, in my opinion, in a lot of instances. Again, I say this on a lot of videos, not investment advice. I'm not telling you what you should specifically do. I'm just helping you trying to think this through. Percent of employees with a stock allocation higher than suggested. I don't even like this report at all. That's decreasing. Why is it decreasing? We just saw it. It's because of the auto enrollment feature. So I'm just gonna move on this. Percent of employees holding 100% or 0% equities. That's a big difference, huh? 100% or 0%, one or the other. So I guess in 2021, 9% either had all equities or no equities. Did I read that right? That's bizarre. No equities, 100% in bonds, 9%. What else would be inside of your plan besides equity and bonds? I don't know. What do you have in your 401k or retirement plan that's not equities or bonds? 100%. What other categories are they talking about? I don't think there's alternatives in a lot of these plans. Trends in workplace managed accounts. The percent of plans offering a workplace managed account has continued to rise. Additional insights. While plan sponsor adoption of managed accounts has grown, participant adoption is still relatively low. 50% of larger plans, so that's with over 1,000 participants, have adopted a workplace managed account. So percent of plans offering workplace managed accounts. So I'm not certain what they're actually referring to as a managed account here. I don't know if it's just, okay, we're going to actively manage it. We're going to talk to you and figure out what your particular risk tolerance is to figure that out. And I don't know if they're referring to target date funds. I'm just not sure what they're referring to as the managed accounts, because I know a lot of different firms call managed accounts differently. Participants' adoption of workplace managed accounts. Maybe that's partnering up with a financial advisor who can kind of give you guidance on that. Here's the note of caution if that's the case, okay? They don't know your whole situation. That's the truth. Just because you're talking to one of these reps, they don't know. If they're not a financial advisor that's going to look at everything, they don't know what's going on. They're just going off of a cheat sheet and saying, hey, how old are you? What are your goals? Like a couple of goals, maybe some points, and then they're just going to choose something really, really quickly. I don't know if that's right for everybody, because I think on the managed accounts, again, they're just talking too much bonds on this stuff because it's the safe thing to do, just because that's what the regulators have decided. So I don't know. Trends in DC investment lineups. The largest corporate DC plan sponsors now offer around 15 investment options in their lineup. Ooh, this is a good one. So large employer, average number of investment options offered has decreased from 2011 to 2021. Is a plan better if you have more options inside of it? No, it's not. A lot of people get overwhelmed by looking at their retirement plans because they have so many different options. But if you break it down and you look at a diversified portfolio, just let's simplify this, right? Large cap, mid cap, small cap. Then you can look at growth and value, growth and value, growth and value. So right off the bat, even if that's all you chose, then that is 6 different options. If you look at your retirement plan, my guess is that you have a couple of each. You might have 2 diversified large caps, or balanced large caps, or multiple large growth, or small value, multiple of those. All of a sudden you realize that you really don't have a lot of options. It's breaking it down, so then when you're going to choose which large cap, balanced, growth, or value that you're choosing inside of that portfolio really gets narrowed down. So you're really only looking at a few different options. And that's a great way to kind of break it down. A lot of times when you're looking at the options, they'll already be segmented on the page that you can have the list of all your options. Sometimes they'll say like, these are all of your equities or your internationals or your bonds. They'll break it down in some sort of an asset class to help you or give you some guidance that you could break it down. So when you initially look at the list, you're like, oh my goodness, I have either 15 or 25 different options. You can break it down simply and really, you can do this relatively quickly. It's not that difficult. You can even look at the target date fund just to see what their percentages are, and then go to the individual options and then tweak it to what you feel comfortable with. So that's another way you can do it. Just look at a target date fund. All target date funds are different. None of them have the same allocations. There is no one formula that says you should have 20% in large cap or you should have 30% in large cap if you're this old. Fidelity has decided on it. Another fund family has decided on it, and they come up with their own allocation. So there is no one way of doing it. So if you look at the target date funds and see how those allocations are built, they will look different than other target date funds and other allocations. So just fun fact. So there's no right or wrong reason on some of this stuff. Some of it is almost arbitrary. People don't want you to think that though. Percent of active participants requesting loans against the 401k. Kind of interesting. Loans and withdrawals starting to increase. Why? Right there. CARES Act provisions allowed you to tap your 401k and kind of do this payback option. I think it was over 3 years. I did a video on it. I don't even know if it says it here, that you could take it. I think you could take out to up to $100,000 and then repay it over 3 years. I think that's what the numbers were behind it, but it's been months since I saw that because it's so infrequent that I actually run into it, which I'm sure from a percentage, let's see, yeah, look at that. Percent of active participants requesting the loans, super low, 2%, 1%, 2.2% in Q2 of 2021. Really, really low relatively. Percent of active participants requesting distributions, percent of active participants requesting loans, requesting distributions. So how you're doing it, taking the loan or taking the distribution. So what I was just talking about was the distribution where you could potentially pay it back and spread those taxes over the 3 years and then also pay it back. So it's when you're realizing those the taxes, so you don't get whacked. I think that might already be done too. It might have had to have been done by 12/31 of 2020. I don't know. If you've done it, let me know in the comments down below. Or if you have a question on it, let me know. I know I did a video on it a while ago when it came out. Outstanding loan balances down. So percent of participants with loans outstanding. So repaying these loans. That might happen for a variety of reasons. So while the initiation of new loans and withdrawals increased, outstanding balances were down. This might have occurred because if you've left the employer, now you have an outstanding loan and you want to roll it into an IRA, then you might have just taken that in as income instead of the loan and gotten rid of the loan, or figure out how to pay it back to roll it over. There's a lot of things besides just saying, hey, we're actually paying it back. That might give you the impression that people are actually paying these things off. And I don't know if that's necessarily the case. Despite recent increases in Q2 2021 newly initiated loans, the percentage of workers with an outstanding 401k loan dropped from 20.1% in Q2 of 2019 to 17.5%. I would bet that is one of the reasons why. It's not necessarily saying, hey, people have money, let's just go ahead and pay off this loan. That could be true for some people, but I don't think for everybody. Roth 401k, percentage of plans offering Roth is increasing significantly, but it's probably also because more plans are offering it. Let's see. In just the last 5 years, the percentage of plans offering, there you go, the Roth 401k has increased by 30%. And with this option being increasingly popular with younger participants, contributions are also on the rise. Why don't all plans have the Roth 401k? I wish they all did. They should all do. It should be just, you cannot open the plan without the Roth 401k option. I think that's silly not to have it. It always comes down to cost, because then you have to manage 2 different plans or 2 different accounts. So then the broker dealer that's opening these plans says, oh, if you want to have this, then we're going to need to charge that. Oh, the employer's looking at it and saying, okay, well, can we do it if we get enough people to save into it? So additional insights, millennials are the most likely generation to be contributing to Roth, increasing from 10 to 16 in the last 10 years. Not surprising at all. So many videos out there on the Roth IRA, Roth 401k, Roth side of life, as if it's the only plan you should ever invest into. Not true at all. I've done a ton of videos debunking that, going against that. I love the Roth plan, but it shouldn't be the only thing that you do. Again, it goes back to, should you just talk to an investment advisor when you're looking at your 401k? No, because they don't know everything else. Think of it. You want to smooth your taxes out. You don't want to you don't want to crush your taxes today just to have them spike tomorrow. You just don't know about that, or vice versa. You need that kind of that balance. So in certain years, it makes more sense. And this goes back to looking at credits and deductions. A lot of people just forget about it. They forget about there's so many different credits at so many different income levels that so many people will take a look at this stuff and they will say, well, my income's at $150,000 or my income's at $250,000 and my buddy did it, so I'm going to do it too. But your family dynamic might be different. What if you have kids? Then you can get the child tax credit if you get it below 150. But let's say you're at 175 and you're not making any effort and you only have one child, you might miss out on the child tax credit, a few $1,000s. So it's free money. So something to consider when you're doing something like that. Roth 401k versus the traditional side. So it's not just about doing the math to see, oh, if I put it in the traditional side and I'm at the whatever tax bracket, that's how much it will drop by. Yes, but then take that and add that credit, that it's like a use it or lose it kind of a deal. It's not, I pay 20% with the idea that taxes are going to increase or decrease down the road. That's not the whole picture. So you want to look at that a little bit closer. And if you're a small business owner looking at any of this stuff, or if you have independent contractor work, you also need to look at all that other stuff, like a QBI. So you want to look at that. So there's just so many different things, right? Maybe that QBI wasn't the best example in there, but maybe health coverage is another one. If you can get your health coverage below, you have a marketplace plan, you get more premium tax credits or cost sharing reductions. There's another reason to put it in the traditional side. I'm just getting you to think. I like the Roth 401k, the Roth side, a lot, but I think it gets overlooked as the only plan that you should use because it has this tax-free growth. Yeah, that's great. Tax-free growth is great, but you need to control your taxes today and tomorrow. All right. Tax-exempt balances continue to grow. All right. So the tax-exempt balances continue to grow. Tax-exempt companies such as religious healthcare, higher education, and governmental organizations are increasing retirement savings through engagement and education. So this is more like the 403B side. That's increasing, not surprising at all. People are getting educated. People are understanding what's going on. And just like they said, more plans are being rolled out at these institutions, which is great. So I'm just going to go ahead to the next page. Tax-exempt workers making strides. Same thing. They are. It's almost identical, just breaking it down, granular. Employee versus employer. Same thing as we saw with the DC plans above. IRA trends. All right, here we go. IRA balances. 9.1 million people are saving and investing for retirement through 11.6 million IRA accounts. Roth and traditional. That's where you get the higher number. Where the number of accounts has grown by 13% and average balances have increased 20.9% between Q2 of 2020 and Q2 of 2021. That's not surprising at all. Why? Because people are doing those rollovers. So that's why those balances are increasing. People are losing their jobs, getting laid off, getting furloughed, all of these different options. And you might be looking at that in-service distributions. You have time on your hands. So if you're looking at an in-service distribution, your company allows it. You're like, hey, I want to do my own trading. I want to have more control. You roll it over. Additional insights. IRA accounts owned by female millennials increased by 30.3% between Q2 2020 and Q2 2021. Interesting. IRA accounts owned by female millennials. I wonder what's driving that. Historical IRA average balances. Let me know what you think is driving why female millennials have increased. Do you think it's a factor of everything we've just been talking about? It could be, probably is. And then historical IRA average balance increasing as well. So people want to do their own trading. Those things are also attributable to, from 2010 to 2021, what I've seen in the industry is fee compression. So trading costs have decreased. Fractional share ownership has increased. So this ability for people to trade $100 is possible today. It wasn't really possible in 2010. It was really difficult. It was really expensive. You didn't have that many options. So it's nice to see that stuff has allowed more people to invest in the market. IRA contributions. While not all account holders contribute to their IRA on an annual basis, the number of accounts with contributions has increased by 55.9% between Q2 2020 year to date and Q2 2021 year to date. So annual data. So average IRA contribution amount, historical. I think is all over the board. Oh, not really. By $100. Decreased by 100, increased by 200, decreased by 200, increased by 100, increased by 200, decreased by quite a bit. That's not surprising at all. The annual contributions. People don't know where they are, and they were kind of fearing, even though things might be leveling out across the board. 401k IRA trends. Insights on those saving in both a DC retirement plan and an IRA. That's an interesting one too. Combined balances increasing. Not surprising. People are saving more. People are getting educated. More plans are being rolled out to get people to save themselves. And I think, things like YouTube, like this channel, people are more aware of that they have this option, the ability to go out there, open up accounts online, on their phone, from the comfort of their own home. They don't have to be intimidated by a financial advisor. And I think that is a great thing. Do not be intimidated. Combined average balances for savers with both a workplace retirement plan and an IRA. I mean, it's almost like this is the group of workhorses who are saving, right? If you're saving into your 401k and your IRA, you're gonna make it happen. And then when there's less to do. So if you have your 401k, that means you're still employed, right? It means you probably still were making money through the pandemic, and you're doing less. You weren't going out as much. So that starts to creep up quite a bit. Not surprising to go from 2018 to 2020 and then increased it even more in 2021 because people get excited about a rising market and they want to get in on the action. So they start to save. Interesting. Contributions. Average IRA contribution amounts for these, again, the same plans all over the board. I'm surprised that the IRAs have decreased. Just the opposite of what I just said. And that's the last page. So contributing to more than one retirement plan takes budgeting and dedication. Contribution rates have recovered following the financial crisis of 2008, 2009, and remained steady the last several years. Also, probably that a lot of people have entered the workforce since 2008, 2009. So they didn't feel those effects in 2008, 2009 to the same degree from their own savings. And that probably had a positive effect. A negative thing in 2008, 2009 had a positive effect because they saw their parents. You saw other people's lives just collapse. And then you know that, okay, I need to get on the horse. I need to make this happen. And that has been a positive thing. So I think that's the right way to go. You know, with making these changes in the savings, if you're considering doing it yourself, the systematic saver is usually the richest person. And the reason that is because they get used to their paycheck. Remember what I said before? You get comfortable in your own financial environment. People are incredibly able to adapt to their own financial environment. So if you can figure out how to create that by starting to save early and often. So if you get a new job, start to save immediately so you don't get used to that bigger paycheck. So you don't even have to make, now I have to make a sacrifice. It's not going to feel like a sacrifice if you just rip the Band-Aid off, start saving right away. Start to save as much as you can. Get that trend going. Even if it's just a few dollars, $25, $10, whatever it is, do it. And then increase it over time. Every time you get a raise, every time you make a little bit more, anytime something positive happens, do it. If you can find a way to bring down those expenses, quickly take that money and put it into the retirement plan so then you get used to it. And before you know it, you're going to be building this up and you're not going to feel it. And that's really what I think is the biggest takeaway of this. You just need to, if this motivates you to save more, go ahead and save more. I don't think I've ever done a video. I might not have done a video ever this long, but if you've enjoyed it, let me know in the comments down below. If you found this information valuable, I'll do more of these types of reports. There's a ton of them out there, but just let me know in the comments down below what you think. Thanks for sticking with me. And if you've enjoyed this video, be sure to subscribe and leave your comments down at the bottom.